Okay, so the first question for chapter 12 has us looking at relevant versus irrelevant costs. So we have the management of Bohème and de Graaf, a Danish furniture manufacturer, who must determine whether certain costs are relevant in two different cases. So case one, the company chronically runs at capacity and the old model A3000 machine is the company's constraint. Management is considering purchasing a new model B3 800 machine to use in addition to the model A3000. The old model A3000 machine would continue to be used to capacity as before, with the new model being used to expand production. The increase in volume would be large enough to require increases in fixed selling expenses and in general administrative overhead, but not in the general fixed manufacturing overhead. Case 2, the old model A3000 machine is not the company's constraint, but management is considering replacing it with a new model because of the potential savings in direct materials cost with the new machine. The model A3000 machine would be sold. This change would have no effect on production or sales, other than some savings in direct materials cost due to less waste. So we have a chart here, and we are going to place an X in the appropriate column to indicate whether each item is relevant or not relevant to each of the two cases. And we are considering each independently. So we'll start with case 1, fill out our chart, and then move on to case 2. So the first thing we're looking at is sales revenue. And the question tells us if the increase in volume would be large enough to require increases in fixed selling expenses and in general administrative overhead, but not in the general fixed manufacturing overhead. And the reason that I bring this up is because all of this tells me that we will have an increase in sales. Okay, buying this new machine, increasing our capacity to more than what it was, to expand production, coupled with an increase in volume that increases our fixed selling expenses, is going to result in a higher sales revenue. So if we don't purchase that machine, our sales revenues will remain at what they are. If we do purchase, they are going to increase. So that means it is a relevant, revenue. Okay, it's not really a relevant cost because we're looking at the benefit of increased revenues here, but it is relevant to the decision being made. The second is direct materials. If we purchase this machine and we expand production, we're going to have an increase in volume that is going to increase the need for direct materials. Since that cost varies between the two alternatives, it is going to be relevant to the decision. Direct labor is the same thing. We're going to need more labor to use this new machine in that expanded production. The variable manufacturing overhead, just reading through the question. So there's no increase to the general fixed manufacturing overhead, but if we expand production, we know that the variable overhead will also increase, right? Because variable is based on the number of units being produced. We are expanding production, meaning we're producing more units. The book value of the model A3000 machine is not relevant to this situation. And the reason that I say that is because we are not disposing of the machine. We are keeping it in production, so the book value is not relevant. On that same vein of thought, the disposal value is also not relevant since we are not disposing of the machine. When it comes to depreciation, I think I missed a row. Book value, disposal value. Yeah, sorry. There should be one more row in here that is for depreciation on model A3000. Sorry. So even though I've now included that, it is also not a relevant cost. The reason being that we're going to incur that depreciation whether we purchase the second machine or not. So when it doesn't change between the two scenarios, it is not a relevant cost. The market value or the cost of the new machine is relevant, right? We won't incur that cost if we don't purchase the new machine. So it changes between the two alternatives, meaning it is a relevant cost. The fixed manufacturing overhead, looking at what case 1 tells us, the general fixed manufacturing overhead will not cause any increases. So that means it stays the same between both alternatives, making it an irrelevant cost. The variable selling expense, we know if we're increasing production, we're increasing our sales, we are going to be increasing our variable selling expense, which means it is relevant. And they told us that the increase in volume is large enough to require increases in fixed selling expenses and general administrative overhead. So if the cost increases, it changes between the two alternatives and it is relevant to our decision in whether or not we purchase this other machine. Okay. So case 2, I'll read one more time. The old machine is not the company's constraint, but management is still considering replacing it with a new model because of the potential savings in direct materials cost with the new machine. The A3000 machine would be sold. This change would have no effect on production or sales other than some savings in direct material costs due to less waste. So we know that it's not going to impact our sales. If it doesn't change between the two alternatives, it is not relevant to the discussion. It will, however, save us some money in direct material costs due to less waste, so that is relevant to the discussion. The direct labor is not going to be affected, so it is not relevant. Variable manufacturing overhead is not going to be affected, so also not relevant. The book value of the old machine is a sunk cost, right? Whatever we paid for that at the beginning is a sunk cost. We're not getting it back, so that is irrelevant. The disposal value of the A3000 machine. Okay, so if we're going to replace this with the new model, we're not keeping the old one. Any money that we can receive on that is going to be a relevant cost. The depreciation that we've already paid on model A3000 is a sunk cost, so it is not relevant to the decision. The market value of the new machine is relevant, right? Because if we don't buy it, we don't incur that cost. The fixed manufacturing overhead, it doesn't say anything about that changing, so it's not relevant. Same with our variable selling expense. Our production and sales are remaining the same. Our fixed selling and our general and administrative are all not relevant because they are not changing between the two scenarios. Okay. So once again, if you are watching these videos and you have questions on why something's relevant or not relevant, just make a note, send me a message on Teams, and we can go over it together. So in terms of question number 2, we are looking at the decision on whether to drop or retain a segment. So Cumberland County Senior Services is a nonprofit organization that is devoted to providing essential services to seniors who live in their own homes within the Cumberland County area. 3 services are provided for seniors: home nursing, Meals on Wheels, and housekeeping. In the home nursing program, nurses visit seniors on a regular basis to check on their general health and to perform tests ordered by their physicians. The Meals on Wheels program delivers a hot meal once a day to each senior enrolled in the program, and the housekeeping service provides weekly house cleaning and maintenance services. So we're given data and revenue, on revenue and expenses for the past year in total, as well as each of our segments. The head administrator of Cumberland County Senior Services is concerned about the organization's finances and considers the operating income of $5,000 last year to be razor thin. Last year's results were very similar to the results of previous years and are representative of what would be expected in the future. She feels that the organization should be building its financial reserves at a more rapid rate in order to prepare for the next inevitable recession. After seeing the above report, UA asks for more information about the financial advisability of discontinuing the housekeeping program. The depreciation in the housekeeping category is for a small van that is used to carry the housekeepers and their equipment from job to job. If the program were discontinued, the van would be donated to a charitable organization. Depreciation charges assume zero salvage value. None of the general administrative overhead would be avoided if the housekeeping program were dropped, meaning that it would just be reallocated to the other segments, but the liability insurance and the salary of the program administrator would be avoided. So the question is, should the housekeeping program be discontinued? And the way that we're going to determine this is by doing an incremental analysis between our current situation and the alternative of dropping that segment. Okay? So we're going to look at the chart up above in order to write down our current situation. So this is in total. Okay, our revenues are $900,000. Going to change my number formatting here so I don't have to do it for each number. And rather than scrolling back and forth, I'm actually going to copy from the question directly. So our variable expenses are $490,000. Our contribution margin is going to be the difference between our revenues and our variable expenses. Okay, so $410,000. Our depreciation is $68,000. Our liability insurance is $42,000. Program administrator salaries is $115,000 in total. Our general administrative overhead is $180,000. Our total fixed expenses, when we add all of these together, is going to be $405,000. Our contribution margin minus the total fixed expenses gives us $5,000. So now we look at what happens if we drop the housekeeping segment. So that particular segment gives us revenues of $240,000. So if we were to drop this segment, okay, our total revenues minus what that segment earns is going to give us revenues of $660,000. This would cost an overall decrease to our operating income of $240,000. Our variable expenses are $160,000. So we can avoid those costs. So the difference between the two would increase our operating income by $160,000 because we are increasing those costs. Or sorry, we are saving on those costs. So our contribution margin, if we drop that segment overall, is $330,000, which is an overall difference. Oops. One is a negative number, so we're actually adding them together, which is an overall negative or decrease to operating income of $80,000. When it comes to our fixed costs, where is that part? So depreciation Charges assume zero salvage value. None of the general administrative overhead would be avoided, but the liability insurance and the salary of the program could be avoided. So our depreciation is a sunk cost that can't be avoided, so it would remain at $68,000, regardless of whether we drop this segment or not. Okay, so an overall difference of zero. The incremental change is zero. Our liability insurance is currently $42,000, and we know that we could avoid that cost if we drop this segment. So our liability insurance is $15,000 for our housekeeping, which would drop our expense to $27,000, which is a difference of $15,000. Our program administrator salaries are $115,000 in total. And if we were to drop the housekeeping segment, we would reduce this cost by $37,000. And we know that our general administrative is going to remain the same, which is a difference of zero. Adding all of this together, our fixed cost would be $353,000 if we drop this segment. The incremental difference is $52,000. So when we take our contribution margin and we deduct our total fixed expenses, we see a negative net income of $23,000. Or $28,000 is the overall difference. So should we keep this program? So yes, the housekeeping program should be kept, or no, the housekeeping program should not be discontinued. Okay, and we can see that because it's actually generating a positive program segment margin, which provides a valuable service to seniors. Okay, depreciation on the van, like we said, is a sunk cost. The van has no salvage value, so it's not relevant to our decision. The general administrative overhead is allocated, and none of it would be avoided if the program was dropped. So the contribution margin of the housekeeping segment actually helps us to cover some of those fixed costs. If we get rid of that segment, we can't use that contribution margin, and it would result in a lower operating income than what we are currently experiencing. So part 2 says to recast the data in a format that would be more useful to management in assessing the long-run financial viability of the various services. So to do this, we're going to include the incremental analysis for our home nursing, our Meals on Wheels, and our housekeeping. So a lot of this is copying data from the table up above. So I am actually going to, rather than scrolling back and forth, I'm just going to type in those amounts. So our revenues in total were $900,000. Our variable expenses, $490,000. Contribution margin, difference between the two. So here we're looking at our traceable, our traceable fixed expenses. So splitting them up depending on the segment. Of course, in total, it's just going to be our total amount. Our liability insurance, our program administrator salaries, our program segment margins, And then we have general administrative overhead. Okay, so now we're going to break it down based on our segments. So our home nursing has revenues of $260,000. Our variable expenses as it relates to this segment is $120,000. The difference between the two is our contribution margin. Our depreciation for the home nursing segment is $8,000. We had $20,000 for liability insurance. Our administrator salaries were $40,000. Adding all of those together. Oops. Missing a double line showing a calculation there. So our contribution margin for the nursing home versus our traceable fixed expenses gives us a program margin of $72,000. So that helps to cover our general administrative overhead. Meals on Wheels, $400,000, $210,000 for our variable. To get our contribution margin. Our depreciation is $40,000. Our liability insurance is $7,000 for that segment. And program salaries is $38,000. So really all we're doing here is reorganizing the information that was given in the chart so that we can easily see the program margins that relate to each segment. So if you're wondering if the audio cut out, it did not. I just wasn't talking while I was doing those few calculations. Okay, so the overall takeaway here is that even though housekeeping shows a negative operating income, okay, it is still contributing to covering those fixed expenses. So if we get rid of that segment, then we're going to have, we're going to lose the ability to use that contribution margin. Okay, so, excuse me. The explanation from the textbook on this format states that to give the administrator of the entire organization a clear picture of the financial viability of each of the organization's programs, the general administrative overhead should not be allocated. It is a common cost that should be deducted from the total program segment margin. Following the format introduced in Chapter 11, which we did not cover, we produced a segmented income statement, but a better income statement would be showing that general and administrative overhead coming off of the total only and not being allocated between the three segments. So that brings us to the end of 2-2. I'm actually going to pause this video here. I just need to make a quick phone call, and I will do a subsequent video for the last 4 questions.